Mercedes a good team.
All right, ladies and gentlemen, welcome back. We got Chart Talk 98 in the building right here. Got some blood in the streets today, so let's just jump right into the market outlook. We've been very cautious on the market the past 2 weeks as we've seen controlled selling, at highs, along with, some problems under the hood. We saw stocks not moving as well as the indices would make it appear they're moving, which we now can see after today's sell-off. That was the big dogs getting out. That was smart money selling their positions into that strength. So then now we just slam it and retail gets killed. We have done a great job of standing out of the way of this market the past 2 weeks. I've been saying a lot. It's not how much you make, it's how much you keep in these markets. And, just proud of us as a collective, the way we kind of handled the sell-off the past 2 weeks. Just, not really getting hurt at all, where, previous times in my career, I'm trying to push it every single day, and I would have gotten crushed, into these last 2 weeks. Now, accounts sitting at highs, we're sitting pretty, we're ready to go. Mental capital's at highs, so, we handled this pullback very, very well. From a market outlook standpoint, we finally see this trend break, this huge trend that's been intact, since February of last year, but really since, almost October of last year, since that last September sell-off, and now we're getting another September sell-off. So, this is big. Time will tell. Time will only tell time, if that makes any sense.
What did you say?
But, we just got that first pullback. Now it's wait-and-see mode. We don't need to be aggressive. The market's telling us it's more of a risk-off time. And, you look around at world markets, we have the China stuff going on with Evergrande and everything, but we look around to world markets, and it's just, a decrease of risk all around the globe. We look at international markets here, all super red. U.S. markets, super, super red. This is fixed income and bonds and stuff. We don't expect that to move too much. But we're just seeing, a worldwide risk reduction. You're seeing it in the crypto space, in equities. You're seeing it everywhere. So, when that happens, it's time to chill. It's not time to be aggressive. And, that's kind of where we're at right now. What are you thinking over there, Ben?
So the last couple newsletters we've been, again, talking about being hands-off, and we've been talking about that kind of maybe this shift out of this, 3 out of 5 days new all-time high market into more of like consolidation type market. And like you mentioned, kind of since last October, September, we kind of saw a little bit of a consolidation going, in that little 3-month period. I kind of circled it here to kind of represent what I'm talking about. And that expectation of maybe we start to shift into something more like that of a range-bound market with the highs in the S&P being 450 and the new area of support that's to be determined. For now, anything above really 400 in the SPY is pretty much fair game. So if we were to trade in that range, say 400 to 450, that could set us up for a bigger move, to SPY 500, at the end of the year or, into, the new year. But like you said, definitely being hands-off, being very selective, and sitting with cash has definitely been the profitable move.
Right. Sometimes best trade is no trade.
100%. And again, going along with that kind of consolidation talk, we've seen this all year in the mid caps. We've, basically since March, they've been flagging at highs. And we saw the space thing with small caps. So we've seen these two portion markets, kind of flag out and consolidate, where the broader markets like the SPY and NASDAQ have just continued to break out. So my thoughts are we kind of shift into a similar market like we saw with the small mid caps, where we just trade in that range. And we'd be, looking to buy up off of support, but we just don't know where that's going to be just yet.
Right. And the unfortunate part about going on that run that we went on this year is that now that we're finally breaking down from it, as you said, we could, if we dealt with a range-bound market for the next year, that would be healthy consolidation in the S&P, as unfortunate as that is to say, but, that's the reality of the situation.
Mm-hmm. 100%. So with that, I had one quick question that one of the members had, and I think we could jump into top ideas if you want.
Yeah, let's jump into top ideas. The question relates to those top ideas that I was talking about. So right now, the market gets tricky when we're at highs, when we're just seemingly like we're going higher every day, but we're not seeing that action. Right now, when we first see that volatility hit and we get that first sell-off, is the best time to research. This is when we get the most information, the most information about tomorrow's leaders and what's really going to lead the market. So right now is research time to the fullest, and I anticipate October, November to December to be great trading months. So let the rest of this month wash out, and keep the research up. So right now I'm just keeping a shopping list. This Skin, SKIN, sort of recent IPO, very strong earnings. hasn't really flinched at all in this market pullback. If we get another pull in, that's one I would look to buy. I've been talking about this Netflix for a while. If they give us 560, that might be time to put on some risk. With the action we got with the big sell-off, maybe this comes in even more. But when the market's ready to turn, this is one of the first names I'm ready to buy. And that goes along with this UPST. Again, this thing didn't even flinch today. It's up, almost 100% in the last, month? But these are the type of names, when they finally do come in, those are buying opportunities a lot of the time. What else? And then DOCS, Docs, recent IPO, that's starting to come in. If we get this one, 68-ish, back to these previous IPO highs, the 66 area, that would be a great setup. And then, what we were talking about was the airlines. The airlines are screaming about their relative strength today. We look around, we look at UAL, United, they closed green. Look at Delta, DAL, they closed green, nice little consolidation. Look at AAL, very similar chart setup there. And Southwest, LUV. All these guys are looking the same. All these guys are looking like they want to bounce. And then when you factor in what the market did today, how it just puked for most of the day until we saw that end of day buy, of course. But in a broad sense, they didn't flinch at all. So now I'm going to have a laser focus on the airlines going forward because of the information we got today. And a couple others is this TDG looks really good. But I think the airlines are screaming at us today that they're going to be a buy very soon. But that's really it for me. Research mode. Don't put yourself in harm's way during these times. It's not worth trading the hardest markets. And if you do, shrink your time frame. I'll still probably take some trades here and there, but very small time frame trades. Take advantage of volatility. So that's really my plan when volatility hits. I sound like a broken record at times with that stuff, but it works. It works. It's very profitable to trading. So that's really it. Just keep my eye on those few names, and then going to expand the research a bit. And, it's watch time right now. It's not time to just pound the keys every day. What do you got?
Definitely. I mean, even for airlines, it's funny you mention because we have not spoken about airlines in probably more than a year and a half.
Right,
but looking at those, at that handful of them, it's like LUV to me is probably one of the best ones just chart-wise up through 65, where that,
LUV?
LUV, yeah, Southwest.
Through 65? You mean 50?
No, I'm zooming way out. If you go.
Okay.
So I'm just looking at some of those charts. If you look at DAL, still nowhere near. It's kind of pre-COVID high. Again, I haven't looked at airlines so long, but Southwest LEV is one of them that it at least has gotten and exceeded its pre kind of COVID area, and that would be, again, in time through 65 would be a blue sky breakout that I wouldn't mind taking right now. Again, yeah, up through probably 52 or 50, but just looking at those really quickly, that was one of the best charts among those, just from a bigger time frame. But yeah, so the couple I'm looking at, I like this IART, which is the name that you guys were trading a few weeks ago.
Yeah.
Again, kind of just settling out here, maybe up through 70, up through 72 versus 68 area is one I'm keeping an eye on. Another one was REZI, which was a kind of a recent IPO. I think it might have been Mark. I can't remember exactly who mentioned this name, but again, we see that 32. If we zoom out, that's that prior all-time IPO high in late 2018, and we can see it finally gotten back up there, and it's buying with that area. Now again, it's gonna be very difficult to buy 32 and be perfect in it, but if we can find some little support buys here up through 27 versus 25 to be in if that move is ready, we can kind of look to sneak into some of those. DRI is another one that we've been watching for the better part of 2021. Has been flagging in this all-time high area up through kind of 152, 154ish versus 145. TXT, another one, again, we took that up through 70 earlier in August. We got blue sky breakout. It didn't really have much momentum through that high, but it is, we can find a little sneaky buyback up through 70.
TXT, same sector as that TDG. So maybe, aerospace and defense telling us something today.
Yeah. Oh, yeah, they both look pretty good. And then lastly is this MU. I think in time up through 75. We can get an eventual move back up to that retest, that 95 area. But again, a lot of these, like you said, it's kind of wait and see, be very patient, and just get the shopping list ready.
Absolutely.
All right, so we went over that question.
You didn't even ask the question.
Okay, yeah, so we'll go very briefly. It was when you see names setting up setting up sector-wide, such as airline or cruise lines, and much names look very similar in pattern. What's your next criteria to look for? Is it volume, beta, fundamentals, etc.?
I'll always look towards the fundamentals, maybe, but in the case of these airlines, where they're all trading pretty similarly, that all their earnings are very similar. There's no like high growth company out of them. When you compare them to each other. So I'm just gonna go chart by chart with it. We look at this LUV, still below its 200 and 100 SMA. Don't love that as much. We look at DAL, Delta, still there. That's also below that. American Airlines, that's a little better. AAL is looking a little better. What was the last one? LUV, AAL, DAL, UAL. So, out of all these, I think American Airlines is looking at the best. Just had the strongest day today on the weakest market action. So things like that, the relative strength, this seems to have the most relative strength of them. So if I had to focus on one of those names, it would be this AAL, just because the chart looks least damaged compared to the rest. So really, I'm just gonna I'm gonna get the sector ready, see what sector I like, and then I'm gonna fine tune the charts and be very specific about the price action within the charts on a micro standpoint. It showed the most relative strength today. It's the least damage of the chart. It's only 20% off these recent highs. So this one looks pretty capable of bouncing very soon. So really, it's just like taking in a number of factors all together, and just using your logical abilities to figure out which one is the best, or which one's has the best chance of bouncing soon. So I would say it's just chart based on the most simple state. But if we're looking at growth companies, like for a while we were watching Edit, EDIT, and this Crisp. Edit is clearly the leader in the space, so I would gravitate towards Edit in that scenario. You always want to gravitate towards the leaders of a sector. So yeah, I think that answered it. What we got next here?
Tough idea. Good amount trade.
Best trade. You can look at the chart talk 2 weeks ago when we filmed it in the middle of the market. I was like, I'm getting the hell out of all these stocks. I'm not sure if it's the right decision at this point, but now look at it. It's like I saved myself so much pain selling into that strength there when we were recognizing all the damage under the hood of the market. So the best trade for me was no trade, and I haven't really done anything since 2 weeks ago.
Okay, so I got a couple. So I've been milking a few of these longer term swings for the better part of the last half year, and two of them was MMC and UPS. Both are names that I basically got in the same day, and both are names I'm getting stopped out of basically the same day. So MMC got in up through 120, added up through 140. I sold the higher cost basis stock around in the 150 area, continued to grind higher. And if I zoom out the chart a little bit, you can just see kind of how vertical and extended this name has gotten relative to that blue sky breakout. So as much as I could have wanted out of this name in 6 months, I think I pretty much got as much as I could. And now it was just time to get things up 30%. Let's just take these gains, because just as quickly as these stocks have that ride up, they can just as quickly reverse them and be back to where we're buying them just as quickly. So this was just
quicker.
Or more. You often quicker, but again,
stairs
this is
up and elevator down.
Yeah. So this was one where it was just kind of time to take profits. Again, if you look at it at this chart, just looks very extended. Almost pretty much made the measure move of this drawdown, and that's usually kind of the measure moves of these bigger patterns. You see these big shakeouts, so maybe it could have gone a few more points, but I'd rather just take the profits and move on. And the other one was this UPS. Same thing, kind of got in around the same time, held through earnings again, and as it started to gap down and base down here versus 190 versus 200, it looked fine. I actually added up here through 195, kind of in August. Even though when it gapped down on earnings, it was still in this kind of bigger range, and everything looked fine recently until it wasn't able, the last couple of days actually get back up in the 200 area. So for the last few months, it would trade up to 200 until 190, and everything was fine. No one really picked, buyers, sellers didn't really pick, make a stand just yet. But as of late, when it came down into support again and only bounced a few dollars and rolled back over into lows, it was starting to show that maybe the sellers were taking control of UPS, and maybe it's going to kind of fill the gap and come back down lower. So this was a name that it was probably time for me just to exit and take the 18-ish% gain that I had made in it. So again, both those names, put them on about 6 months ago. Both of them basically got stuff out of them today and yesterday and Friday, And then just a few other ones, the CTAS, we can see how, again, we talked about this last week in the chart talk, just kind of taking the gain and again, right back to the price. And QSR was another one, like was looking for this breakout through 65 and it just couldn't go. Went 50 cents in my favor, less than half a percent or 1% in my favor. And it just quickly came back. It was just easier to take the break even, and you fast forward today, it's almost 10% lower. So this was a break even trade where this quickly could have turned into a 10% loser. So just us just keeping our risk tight and not giving our profits back to the market.
Love it.
So those were the couple trades I had. Did you have anything you want to jump in and say related to UPS, or it was just a recording issue?
It was a recording issue.
Oh, okay. All right. So with that, I think the only thing left is Book of the Week.
All right. So I started reading more of that Biggest Bluff. I got a few lessons for the next handbook we're doing. Keep your eye out. Mm-hmm. This book started off slow, and I was kind of getting sick of it, and then it really, I think it got really good from a risk perspective. It's all about poker and this woman's journey about how she became pretty much a no-name into a big player, and she studied under one of the best players and things. But she talks a lot about risk. And how humans handle risk, and obviously you go on a winning streak, you're happy. You go on a losing streak, you're sad. But what it really, the chapter I just read recently that was really good. It talked about risk variance, and humans, we have what is it called? The law of small numbers, or the small number probability, whatever it is. I forget the exact name. It's pretty much like humans are trained to think that large numbers will effectively come in the same as small numbers. What I mean is, if you flip a coin 1,000 times, you're much more likely to get 500 heads than if you flip it 10 times, then you are to get 5 heads. Meaning it's much more likely to get 8 heads out of those first 10 than it is to get 400 out of the 500. What that relates to in trading is dealing with the variance of trading from an emotional standpoint. You look at your trades over a year. Let's say you win 40% of your trades. Okay? So you're thinking, okay, I should win 4 out of every 10 of my trades. But that's not how small numbers work. You might rack off, 15 wins in a row and then go off and lose the next 25 trades or whatever it is. And it's so unfathomable because you're thinking, I win 40% of my trades. But the law of small numbers kind of tricks humans into believing that. Whereas, embrace the variance, where that's just kind of the natural course of trading, where you're going to have winning streaks and losing streaks. And over time, you don't allow it to affect you as much emotionally because you've been through it, you've seen it so many times, and you're just almost expecting it. So I've just never seen it put in words so really, simply as she did. But the main takeaway for me in that chapter was, understanding and embracing the variance in risk. Where you're not going to win 4 of every 10 trades. You might at the end of the year, but you might have 10 losses in a row before you have 10 wins in a row. And that's kind of just the variance of trading and what you have to come to expect. And, the reason I have a lesson in the handbook talking about, hot hands and things, and how you shouldn't, if you're hot, you shouldn't push it. And if you're cold, it's probably when you should take some time off. But mostly for me, when I'm hot, I do push it because, usually it's an indicator of the market, and then sectors are breaking out in mass, which is when we want to be the most risk on. But, from a variance standpoint, you have to embrace the runs so you're not as emotional on the downturns. And, that some really good lessons in that book.
Nice.
Yeah.
All right, so I'm reading Switch. This is one I had this book for years. I just picked it up off the bookshelf, and there was a couple, they give all these little examples of how these companies and businesses just make things easier for the employee or for the individual. And one that was pretty striking was they ran this study with doctors who had to administer or determine whether a patient needed to get hip replacement surgery. For those that don't know, it's very painful and it's a long rehabilitation process to get that surgery. And they put these doctors into 2 basically blind studies. One, the patient had 1 drug left that he could take or get the surgery, and then the other example was the patient had 2 available drugs left before needing surgery. And it was the doctor's decision of what if the patient should take the surgery or take the medicine. And the interesting part of that is most would think that if there was more available drugs, that the doctor would be more likely to prescribe one of the two drugs over surgery, when it was actually the opposite. When there was 1 drug available, that it was like a 50-50 chance of the doctor prescribing the drug or the surgery. When there was 2 drugs, when there was more options, the doctor was 80% more likely to recommend the surgery than recommending the drugs, because he had 2 choices. He didn't want to have additional options. He wanted just either A or B. Where with those additional drugs, it was he had to then determine which of the 2 drugs to choose. And he was like, yeah, and he's like, screw it, just do the surgery. And there's like, and it's like, that's like terrifying.
Yeah.
Where these are like, this is a medical doctor, but then it's like, nah, 2 options, nah, just open them up, rip the hip out, and put a new one in. Which I thought that was, pretty wild.
Yeah.
There was a few other, again, it's a pretty interesting book. A lot of little lessons like that you bring up and you're just kind of shocked over just how we act and how to make, that was to me was shocking.
Yeah.
But that's really all I got.
That's good
that
stuff.
I can
Good stuff.
think of this quickly. So yeah, I think that's it.
Let's wrap this thing up. Like, comment, subscribe, questions. You know the deal at this point. Chart Talk 98 in the books, huh? We popping bottles in 2 weeks. I'll be ready. All right, we'll see you guys till then. Next time.